Starting to invest as a teenager can have a profound impact on your financial future. By beginning early, you give your money more time to grow through the power of compound interest. Even small, consistent investments can accumulate significantly over the years, helping you build wealth and achieve your financial goals sooner. Developing smart investing habits early also provides valuable experience and confidence for managing money throughout your life. Investing is the process of allocating money with the expectation of generating a return or profit over time. Some fundamental terms include stocks, which represent ownership in a company, and bonds, which are essentially loans made to governments or corporations. Diversification refers to spreading investments across different assets to reduce risk. Risk and return are closely linked, with higher potential returns often coming with greater risk. Understanding these core concepts is essential for anyone starting their investment journey. Teenagers today have access to a variety of investment options that can help them start building wealth early. Stocks offer the opportunity to own a share of a company and benefit from its growth, while bonds provide a more stable, fixed income investment. Mutual funds allow investors to pool their money with others, gaining exposure to a diversified portfolio managed by professionals. Exchange-traded funds, or ETFs, combine the diversification of mutual funds with the flexibility of trading like stocks. Understanding these choices empowers young investors to make informed decisions about their financial futures. Compound interest is a powerful force in the world of investing. By reinvesting earnings, your money begins to generate returns, not only on the original amount, but also on the accumulated interest. This creates a snowball effect, where growth accelerates over time. Starting early is crucial, as even modest investments can expand dramatically when given enough years to compound. The longer your money is invested, the greater the potential for substantial returns, making time one of the most valuable assets for any investor. Teenagers interested in investing have several options for opening investment accounts. One common approach is through custodial accounts, where a parent or guardian manages the account until the teen reaches adulthood. These accounts allow young investors to start building their portfolios while learning about financial responsibility. Alternatively, joint accounts can be opened with a parent or guardian, providing shared access and oversight. Both methods offer valuable opportunities for teenagers to gain hands-on experience with investing under the guidance of a trusted adult. Developing strong financial habits is essential for long-term stability and growth. Start by creating a clear budget that tracks your income and expenses, helping you identify areas where you can cut back. Make saving a priority, even if you begin with small amounts, as consistency over time leads to meaningful results. When it comes to investing, set realistic goals based on your financial situation and risk tolerance. By following these steps, you lay a solid foundation for a secure financial future. Investing always involves a degree of risk, which can range from market fluctuations to unforeseen economic events. By understanding these risks, investors can better anticipate potential challenges and avoid costly mistakes. Making informed decisions requires thorough research, careful analysis of financial data, and staying updated on market trends. Diversifying investments and setting clear financial goals are effective strategies to minimize potential losses. Ultimately, a thoughtful approach helps safeguard assets and supports long-term financial growth. There are a variety of resources and tools designed to help teenagers learn about investing and monitor their growth. Educational websites and apps offer interactive lessons on basic financial concepts, making it easier to understand topics like stocks, bonds, and mutual funds. Many investment platforms now provide simulated trading environments, allowing teens to practice investing without risking real money. Additionally, budgeting and tracking apps can help users set financial goals and observe their progress over time. By leveraging these tools, teenagers can build a strong foundation in personal finance and develop healthy money management habits. Many young investors fall into common traps, such as trying to time the market or chasing quick profits. It's important to avoid making impulsive decisions based on short-term trends or emotions. Instead, Focus on building a diversified portfolio and maintaining a long-term perspective. Staying motivated can be challenging, but setting clear financial goals and tracking your progress can help you stay on course. Remember, patience and consistency are key to achieving lasting investment success. Starting to invest early offers significant advantages, allowing your money more time to grow and benefit from compound interest. By taking the first steps now, teenagers can build a solid foundation for financial independence and future security. Early investing also encourages responsible money management and helps develop valuable financial skills. Embracing these habits at a young age can lead to greater opportunities and confidence in handling personal finances throughout life.